There seems to be a trend here recently where I'm meeting some prospective clients across Canada that have a dividend aristocrat or a dividend investment strategy. And what they really mean is that they just seek high quality, mature companies that are paying, more substantial dividends or elevated dividends relative to the market. And that's their words. That's not, that's maybe an improper way to define it. But the reality is what they're trying to do is they're seeking the income that comes out of these securities. So for instance, if you own Royal Bank and it pays you a 4% dividend, they tend to be more favorable to those types of securities because of that 4%. When really what they're not connecting with is that 4% doesn't fall from the sky. It comes from earnings, net earnings, and cash flows. And so it does not matter what the dividend is. If you do not have net earnings that are strong, chances are increasing in value, and you don't have growth with your company or a lot of free cash flow, the dividend is irrelevant. We've seen this with lots of energy companies. Vermilion Energy, there's dozens, if not hundreds of examples. And when they run into a cash crunch situation or an unfavorable market, that's going to affect their cash flow and reduce the dividends. And you must remember that even though you have a dividend investment strategy, by definition, and we've covered this consistently on this channel, is that 95% of all actively traded or speculative investment portfolios, including ones where you're choosing dividend payers, underperform the index. And what's interesting is the index is still going to pay upwards of 2 to sometimes 4%, depending on the valuation of the index, in dividends anyways. And you don't have to worry about having a security go to zero or having a colossal loss in any sector, and you're going to be able to have consistent returns. So again, I get that dividends are attractive. When you see something that's paying 7, 8, 9, 10%, or even say above 4% on a consistent basis, and you think that you can just let the price fluctuate and you'll get paid that dividends, you're failing to focus on you want an investment return, not necessarily a dividend. And because the global equity markets will, on average, this is historical over the last 100 years, grow by 5 to 6%, that will be the growth rate of their earnings, and also paying a 2 to 3% dividend, and that's just the broad market index. Why on earth would you ever focus on individual names and enhance more risk into your portfolio? Not to mention, when there's a massive sell-off that happens in an environment such as March, how are you going to pivot and take advantage of those opportunities when you're 100% invested into equities? So be mindful when you're choosing a dividend strategy that it may not necessarily be all that it's shaped up to be. And we'll go over more math in future videos on this, but again, chasing dividends is always a dangerous protocol, and we would rather see a well-diversified portfolio with alternative investments, with hard assets, non-correlated securities, so that you can live to fight another day and you never have to worry about the price pressure that comes when markets crash. And especially when you run into major economic headwinds like what we're probably going to see over the next couple of years, dividends are going to get affected because cash gets affected. So remember that dividends are not exclusive from earnings and cash flow, and they are one and the same.